Hello, this is Samie and I welcome you all to eAcademe from the platform of CA Educationist. In this video, I will be comparing equity finance with debt finance. Finance is the lifeblood of every business. No matter which business you plan to start, you need finance for that. Likewise, if you need to expand your business, it is not possible without the availability of finance. Now, the question arises, what are the main sources of finance for a business? The simple answer is you can arrange funds for your business from two main sources. Number one, from owners. Number two, from lenders. The finance provided by the owners of a business is termed as equity finance, whereas the finance provided by the lenders is termed as debt finance. Let us have a look at each of these sources in detail. When owners provide equity finance, they are issued shares against this investment. Each share represents a proportionate ownership interest in the net assets of the business. Net assets refer to the assets of the business after all the liabilities are set off. It means that in case the business winds up at any time, the shareholders will have claim over the assets of the business after all the liabilities are paid off, but in proportion to the shares they have. Generally speaking, equity finance providers have voting rights in the business, which means normally they have entitlement to vote on key issues of the business. It is generally one vote per share. However, there is a type of equity share that does not entitle the holder to any voting right. We will discuss about that share in some other video. Providers of equity finance can earn return on their investment in two ways. Number one, capital gains. When a company performs well and reports solid financial results, investors may gain confidence in the company and decide to purchase shares of that company. This increase in demand creates a rise in the share price. Shareholders can sell these shares at high price to earn capital gains. Number two, dividends. Dividends are a certain percentage of a company's after-tax profits that are offered as periodic returns to the equity investors. These may be paid once or twice per year. In a nutshell, equity investment entitles the shareholders to both one-off and periodic returns. Let us now talk about debt finance. When lenders provide debt finance, the business has technically borrowed the loan, and the loan obligates the business to repay the borrowed amount along with the periodic interest charges thereon. The loan amount offered by the lender is termed as principal amount. Therefore, in return for providing the debt finance or principal amount, lenders are entitled to two cash inflows from the business. Number one, the repayment of principal amount, and number two, periodic income in terms of fixed interest charges. Normally speaking, some asset has to be provided as a security at the time of obtaining loan from the lender. This is also termed as the collateral. The objective of this collateral is to protect the lender against the risk of default from repayment of principal amount and payment of interest. In the event the business defaults, the collateral has to be forfeited. Since the loan is collateralized, lender has the foremost claim on the collateralized asset of the business in the event of dissolution. Lenders do not have voting rights in the business. In other words, they will not have a say in the key issues of the business. There are two primary ways of raising debt finance, but we will discuss about that in some other video. Thank you for watching the video. For more videos, keep watching the series of eAcademe from the platform of CA Educationist by Samie. For any queries, you may WhatsApp or email at the given contact details.